Okay, good afternoon, everybody. It's just about 2:01 and we already have 85 people online, which is great. Welcome, everybody. My name is Nick Giulietto. I am the Head of Future Policy at the ABA and really pleased today to be bringing you the third in a series of four this year of webinars focused on some of the impact of technological transition and change in banking. Today's topic sort of really, I think, has big implications. Long time ago, I can remember people talking about the power of a single view of customer, and at that time we were probably talking about 5 or 6 attributes. We're now well past that, and today we're going to explore what the great increase in data, and probably even more importantly, the great increase in data analytics capability will mean for banking, and it's far beyond sort of the transactional stuff, and actually will, as we'll hear, have tentacles, if you like, that will reach out across pretty much every part of a bank, and actually require, in the end, a genuine holistic view of the customer in much more detail than perhaps anyone dreamed of when I first started working in this space. So before I begin, I would just like to acknowledge the traditional owners of the lands on which we meet today and pay my respects to elders past and present. Here at the ABA, we're coming to you from the lands of the Gadigal people of the Eora Nation, but obviously ABA member banks and their services are located across every part of the country. And from all of those areas, we acknowledge the traditional, or the custodianship of the traditional owners of the land. Our speaker today is Chris Evans from Oliver Wyman. Chris's bio that sits in front of me is extremely long, and I'm not going to read the whole thing. The bit that caught my eye is Chris claims to be a qualified hot air balloon crewman and an unqualified father of 2. I'm not going to make any further comment on that, but when he's not doing those things, he heads Oliver Wyman's Australia's digital team and is a partner in their global finance and risk practice. So Chris is going to share his thoughts and some insights from Oliver Wyman on the implications of customer transactional analytics and how that can actually help banks break down some silos and move from a product-centric to a customer-centric view. With that, I'm going to hand over to Chris, and we will chat later on when we get to Q&A. Thanks a lot, everybody.
Thanks, Nick, and thanks, everybody. Now, give me a couple of seconds as I load up the slides that I'm going to talk to. Hopefully that all works. We practiced it just before. So give me 2 seconds. All right. Hopefully everyone can see that. Nick, give me a nod if that's the case. Perfect, thumbs up. Okay, good. So thanks everyone for joining today. Nick, that was an excellent introduction to what I'm going to try and cover in what feels like a relatively short period of time. We're going to talk about transaction analytics and how they are potentially going to transform the way banking services are created and presented to customers, and as part of that, what I think that means for this journey from product to customer. And Nick's right, like the concept of a customer view is not new. It's been around for forever, but I think some things are changing now that mean we as a sector operating within financial services need to think about it differently. So I'm going to talk to you about why I think that's the case. What does that mean? Get into some real examples of how this is actually happening today in the market in places, and some of the things that actually are possible, along with the challenges on the journey, and then open it up to some questions. So put a few thoughts out there about, well, what does this mean? And what are the implications for, maybe for the regulator, the implications for consumers, and implications for the banks and providers of financial services. So that's what I'm going to cover over the next sort of 50 minutes or so. So let's get into it. And I'm going to start with, a little bit of a history lesson, but it's something that I do think about quite a lot. And that is that the retail banking products that we have today haven't really changed in almost 50 years. And in fact, to prove this point, I went and found a bunch of adverts for banking products from 50 years ago. So these are actually 50 years old, these adverts, and they are advertising, a classic mortgage, although obviously the ability to afford a mortgage now looks a little different to what it did back then. They're saying it cost about the same as renting, which isn't quite true now, sadly. We've got credit cards. And yeah, we've got some innovation in sort of what goes with those in terms of loyalty points and some insurance, etc. But they haven't really changed much over a long period of time. We have your generic personal loans, and the only real innovation that we've seen in the blue there is probably the sort of payment style services that BNPL ushered in a few years ago, but otherwise hasn't really changed in many years. And we've got our transaction accounts and savings products, which in Australia at least have still retained broadly the same flavor. Obviously, there's been large amounts of changes to the speed and the security of these products and services and how they're consumed and the ways in which they are distributed via, obviously many of these through digital channels. But the actual features of these products haven't changed very much. They're still, a construct of some form of repayment mechanism, some form of, if it's a credit card, a limit and an exposure and a term. And they have pretty much been a consequence of legacy technology limitations and choices. So if we sort of think about what does this mean, I can move this thing. There we go. This means that banks have really built themselves around these product archetypes in many different ways: financially, organizationally, culturally, and technologically. And that essentially means that it's been very hard for them to move away from those as silos or divisional elements of their business. And so these products essentially have defined how banks have set themselves up. And as I said, there really were constructs of limitations of technology and data from back in the day when these products first arrived, and they haven't really changed. And that means that, although there's been a lot of effort and focus on building out better, smarter capabilities, all of it has typically been aligned with these products and those silos in the bank. So improvements in data, systems, analytics processes have all pretty much been around, let's get a smarter, faster way to approve a credit decision for a credit card, or a digital way to distribute it. For mortgages, the same thing, but very much in the mortgage silo. Your savings products have pretty much stayed, the preserve of online digital distribution, which is where they originated. They haven't really changed. You get some mechanism for earning interest, which might have some variations, but it's pretty standardized. And the ability for banks to look across those products and think about, well, what's the actual customer need and the customer service and how am I helping them do better, has been really hard because of that. Ownership just of that statement and problem is difficult. When I talk to banks in the market, and we talk about the concept of thinking about how do we help the customer achieve or do something better, it's almost always in the context of one of these products or services, and it's very hard to reach across this. So this is a challenge, right? Now, if they can do that, then we're going to see something happen. And I think we're at the point now where we're at this really interesting inflection point in how financial services are going to be developed. We have a number of never-befores, if you like, that are happening right now. First off, we've never had the ability to get hold of all of the transactional data elements of retail banking products. It just has never existed before. It's been lost in many systems. It's been very, very hard to aggregate. And almost all banks are going through their own journeys of technology modernization, where suddenly this data is starting to become available. And obviously, there are regimes in the market that are starting to potentially provide this as well. Even if they could get hold of this data, the technology to be able to ingest it economically didn't exist. And cloud computing is still, an era of the last 5 years, and it's still a transition that many banks are working towards. That didn't exist 5 years ago. It's now there. And even had they had that ability to ingest all this data, the access to the computational horsepower was also not feasible. So all of these things have happened in the last few years to mean that we're at a really different stage in technological development and opportunities that then presents. But it's not just that. The regulatory regime is now starting to expect significantly higher use of this data. They're putting in place the ability to share it securely, and they are expecting banks to use this. I remember building, I think it was the first cloud-based product and service in the market about 10 years ago, and the question was, would the regulator even allow it, and what hurdles do we need to get through? It is now an expectation that banks have modern, secure infrastructure that can use this, and that wasn't always the case. And it's not just what's possible, but what's needed. So the pressure on the traditional banking business model, from your greenfield neobanks, your big tech firms, your fintechs, is growing, and the margins are getting tighter and tighter on the traditional business model. So the expectation to use this is higher, and customer expectation around consumption of digital services and the utilization of the data is also higher. COVID was an accelerator for this, but now customers really genuinely are engaging with banks through digital services, and that engagement level has never been higher. 99% of all interactions are now made by online banking and apps with banks, and that means the data associated with those is digital and available for those banks that can surface it. So this means that we're at this really interesting, exciting point in financial services, I think, and we're going to see some shifts in the way in which traditional banking products are created and brought to customers. And so, what does that mean? So I think it means a few things, and some of these things are not new; they've been happening for a while, but I can see them accelerating in the market. This slide sort of says traditional on the left-hand side is what everybody's familiar with. We still have today at many banks, a manual data collection requirement. Whether it's not for everything, but it is still for some. We need to see documents and pay slips and statements and bills, etc. The risk modeling approach that banks have historically applied are still correlation based, essentially scorecards that tell us about features that might be predictive of whether a customer is going to be at risk of not being able to meet a credit commitment. All of the verification and the assessment of a customer's financial situation still heavily relies on the customer being able to talk about it. They need to estimate what their expenses are. They need to provide verification of their income. And banks essentially need to ask them questions in a manual context to sort of get a picture of that. The focus of banks is still very much on loss mitigation. So how do I minimize my exposure and to losses from customers? And I have essentially a series of what have been static products and services around unsecured and secured. If I think about what does these changes mean for the future state, some of these are obvious. We have moving towards digital sharing of all of our data, and that means a different speed customer experience, which is great. But it also means that we're going to start to see a lot more about customers and therefore understand a lot more about what's driving their behaviors. And that means shifting from sort of correlation, backwards looking modeling to more simulation and causational modeling, not just is a customer likely to default, but why are they likely to default? Is it to do with something in their income profile, their expense profile, the potential exposure to certain shocks, etc.? We can actually start to see the data to do that, and that's going to look quite different from a risk set. So I'm going to talk a bit more about that. We're not going to be doing customer-based assessments of their situation. We're going to have all of the information we need to be able to make a complete assessment of their financial ecosystem, all the flows into and out of the financial products that a customer holds. That's going to look very different. It's going to mean we can, as banks, do things in a much more efficient way, a much more responsible way, and a much more accurate way from an assessment of what customers need and their likely creditworthiness. And now all of that means that we should be able to move from a focus on minimizing risk for the bank to a focus on helping customers get better outcomes, which I think is something that is still not done well today. How do I get a better outcome as a customer from my support of the bank with the services they provide? And this is going to help us do that. And then, with all of these things, we're going to start to see things like unsecured products start to become more like seamless payment services. When I pay for an item, I essentially can choose how I pay for that. And one way might be to borrow from a future income stream that I've got and the bank can see and can recognize. And that becomes a seamless way in which I actually start to use money within my ecosystem. So this is all going to feel quite different, I think, and we're starting to see some of these things come through. Now, what I'm going to talk through and go into a little bit of detail on is what's driving this. And there are many things that are driving this. There's many technology components. I talked about cloud and the use of more sophisticated analytics, and obviously there's a generative AI movement, which everybody's jumping on at the minute. But at its core, I think one of the biggest ways in which this is going to be enabled is through the use of transaction data. So transaction data is the data that describes all of the flows into and out of a customer's financial ecosystem. And it is increasingly more and more starting to capture almost every way in which we as customers engage with our money. So the last 5 years, the proportion of cash transactions, for example, is now less than 8% of total, and it's continuing to go down year on year. And that means that at some point in the near future, everything is going to be digitally enabled and therefore observable and measurable. And for many banks still, a lot of them have primary relationships with customers. So for the major banks, we know that around 50–60% of their customers have what is called a main financial institution relationship. That means the majority of their income is passed through that bank in the service of all of the activities that they do. And in fact, within that, around 30 or 40% of these customers have what we call an exclusive financial institution relationship. That means that the vast majority, if not all, of their financial products and services are just with that one bank. And so the bank has the ability to see all of their transactions in their ecosystem. Now, what does that mean when I talk about ecosystem? We're going to go a bit deep into this. The ecosystem has obviously a number of components to it. It has income, so salary, and there are many different flavors of this. It has other regular recurring inflows. These could be salary related, or they could be to do with government income. They could be trading, they could be dividends, they could be for other bits and pieces. A classic example we see in banking, which is hard to deal with, is people who are sharing apartments with others. One of them might have the primary responsibility for paying rent and would collect rent from their flatmates, and that shows up as an inflow, and it's a pretty important part of their ecosystem, but it's hard to sort of understand and interpret for banking purposes. And then there are other inflows of one-offs. And of course, transfers of cash from their ecosystem into assets and back again. And then out of this ecosystem, we have obviously payments for any credit services they have utilization of cash, they have transfers into other products and services or to other people, and they've got the payments associated with it that all add up to the cash balance that sits within it. And when I talk about a financial ecosystem, this is a concept we're going to go a bit deeper on. That's what we're talking about. All of these different flows into and out of. They have a transaction associated with them and information that we can use to understand the customer's position. So let's go and look at this. What does this mean for credit? And I think when we start to think about this concept of a customer ecosystem, a customer view of financial ecosystem, it's going to need a change in the way banks have historically thought about risk and their risk mindset. So in the past, and even up to today, the way in which banks think about assessing a customer's financial situation is sort of still defined by an approach that was pretty much, again, as I said, sort of came into play about 30, 40 years ago, where the focus was very much on what is it that I can verify that is important about in a customer's financial situation, and let's put all my effort into making sure I've got that bit of that information to do so. So, i.e. salary. I want to see a salary and a pay slip, and that's going to be my way of verifying that bit because I can do it. Bills, I can see energy bills, I can see telco bills, so let's go to those and I can get hold of those because those things I can have some comfort in. And then everything else outside of that starts to become a bit of an estimate, like so estimates of grocery spend or travel costs, etc. that customers have starts to be an estimate that the customer has to come up with. And all of this is a snapshot. So this current label that I have on the chart here says that this is all based on like whatever has happened recently for the customer or their best estimate of it. And even things like credit utilization, so utilization of limits and exposures, are all just as at the point at which the bank is engaging with the customer for whatever it is they need to do. So this is a very incomplete picture. It shows a small part of a customer's ecosystem, but the bit that the banks have historically been able to have some certainty that they can verify. Now, when we then think about what does transaction information do, it allows us to create a significantly more holistic and richer picture of everything that a customer is doing. So this is no longer a sort of snapshot of a small part of the customer's ecosystem. This is everything that's going in and out of it. And that means that we can build significantly more sophisticated ways in which we understand that customer. It's a real live view that is relevant to them today, but it also allows us to understand their history. So we can see the history of flows in and out and associated behaviors that they tell us about how the customer is interacting from a financial perspective. They allow us to understand things like the utilization of credit. for example, not just what's their exposure, but how are they using their limits and exposures if they have them? Are they transactors or are they rainy day credit users for the credit card, for example? From a wealth perspective, we don't look at assets, which has been the sort of historical way, but we want to see cash balance. Unsurprisingly, if you can build a view of the full cash balance of a customer, that is the #1 strongest predictor of their ability to meet credit commitments. But it's not a feature that any bank currently today, outside of a couple, can do, because it's hard to pull and it requires you to see across all of their transaction accounts. So this gives us a very different way to understand a customer's ecosystem. And it's not just anchored on sort of the primary components that traditionally have been the ones that the banks look at. So we're going to drill into this now, because that probably makes sense, but what does that actually mean in practice if we get into like, okay, well, is it that different? So let's look at this, and we're going to look at inflows and then we're going to look at outflows. So starting with inflows, I'm going to drill into a little bit of, what does this look like today? And it won't be true of every bank, but it's true of most banks from our sort of our perspective and looking into the market. And here we've got inflows, so the ease of how easy it is to identify and verify. And the table on the right there shows sort of color coding of, whether this is like fully manual and we just don't know what it is and the customer has to guess and we just take that best guess, through to, fully automated in terms of collection and it's real and it's validated because the source we get it from we know is true. And then on the x-axis of this little chart for inflows, we talk about how much these are considered typically for credit purposes, which is the bit we're sort of drilling into now. And so obviously the first thing we have is sort of your traditional payee salary, right? And this is pretty easy, and most banks, I think, have got some automated ways of identifying this, either from their own transaction data or through other means, and that's kind of fine, right? They're starting to also get more comfortable with payee, which could be quite variable, and a lot of customers these days actually have gig worker or part-time style jobs, but still with a payee salary that they can identify for tax purposes. That's fine. Treatment of that is somewhat non-trivial, but getting more automated. Then we might have people who are not identifiable as sort of payee, for example. They're getting transfers in, but that's still their primary income. That gets a little bit harder because then you need to see them. They don't necessarily have obviously or easily interpretable pay slips, and then you've got your self-employed and your SMEs, and that's harder still. You need to figure out, how do I separate out the personal element of these inflows from the business that the customer is involved in. Well, that's sort of your primary income, but primary income isn't the be-all and end-all now. Like, many customers have multiple sources of inflows into their ecosystem. Many have potentially rental income from investment properties. Some will have very substantial components of government support, which are required given their situation and circumstance. Many have got gig or contractor roles. The rise of the sort of Uber economy, many people are starting to get meaningful contributions to their total inflows into their ecosystem that aren't coming from a primary job, and that's hard for banks to understand. Typically, it's relatively manual for them to look at it. And then, obviously, what has been common is that many people's total income actually has a larger variable, infrequent bonus or commission style type of inflow, which is also, again, difficult for banks to recognize and think about how they consume for credit purposes. This is kind of typically where we get to, but then there are other types of things that are also hard. So partner salary. 30% of retail customers have a joint account, which has typically one or both of the salaries going into it. And that's difficult for banks to sort of unwind and figure out, well, what does that mean for this individual who's applying when they have an account which has someone else's salary, and when does it become theirs to use is an ongoing debate in the industry. Obviously, there are those who are retired and have super in various different forms, and that's difficult to assess. And then there's a whole heap of other types of income, which typically are not even considered, but can and often do create a meaningful part of the inflows into the customer's ecosystem that are just not thought of for credit purposes. So we've got dividends, trading income, other transfers that we don't know where they come from. We've got tax refunds, asset sales, even for students, meaningful, regular, recurring parental contributions. These things are all part of that ecosystem and need to be considered when you're looking at it in its entirety. So if we then look at the expense side and go down just to sort of close out this example. Again, ease of identification, verification sort of on the y-axis here, and then what might be considered essential spending through to discretionary, and sort of in turn is sort of somewhat correlated with its consideration for credit underwriting. We've got the obvious first two, which is the living costs, so mortgage payments and rent. Mortgage payments, again, most banks, or some banks are now able to sort of automatically identify this, particularly if they own the mortgage. They should be able to, but it's never as easy as you might think it would be. Rental, typically you need to bring your rental contract in to show what your rental is if you're applying for a mortgage, even though that information should exist in the transaction data. It does. Then you've got the other bills I talked about, utility bills, and then insurance, which is a critical piece for credit assessment of understanding a customer's ability to withstand shocks to their expense profile. And then other parts of the expense profile, credit payments, etc., tax, payday BNPL, for example, which typically is currently not easily identified. It's not reported on by the bureaus yet. Probably will be, but it's still not easily identified for purposes of credit today. And then there's all of the other expenses that make up the majority of a customer's profile. And at the moment, these are still best estimates. You know, your school fees, your groceries, your medical expenses, other living costs, travel. Typically, customers are asked to estimate these, and some banks will do some attempt to validate these, but it's typically compared to benchmarks like HEM, which are relatively coarse and definitely inaccurate to the customer-specific situation. And you know, we're all aware of probably the Wagyu and Shiraz, Saga, or Westpac. You know, there are obviously other components of a customer's expense profile that relate to lifestyle that are even harder again to estimate and take into account. And then further still, things that they're just not considered. So other uses of cash, other potential travel, other large one-off expenses typically are not able to be considered for credit. And but there are some types like gambling, for example, that banks will try to identify where they can. So this essentially is a partial coverage. Like, it's a part of what customers do with their financial ecosystem, and it's a best guess in many cases, and it's significantly inaccurate. It hasn't really changed in many years. So transaction data is really going to change this, right? It provides real-time, verifiable, statistically modeled data on all of these flows. And what it means is when you wash the transaction data against this, is you get a full and complete picture if you have all this transaction data of all these retail products. And so most of, not all of these things can be fully automated for identification. Some of them might require, again, some conversation with the customer to understand, well, what is it in the context of it? But for a large part, you can see what these are, you can see how they're flowing in, you can see what their statistical properties are. And that's really important, right? That's powerful. Because when you think about what your banks currently do, they just collect a static view or through the last 3 pay slips, for example, to verify these. But with transaction data, we see much, much more. And for every single one of these pieces of the flow into and out of the customer's ecosystem, we then actually able to build really interesting and valuable metrics that tell us about it. So examples of these are on the right-hand side, but we can obviously see when was the last time they were paid. We can see all the statistical properties, the mean and the variation and the periodicity. How frequently are they paid? When's the pay cycle? What's the variance in the pay cycle? How many times have they been missed in the last few months? When do we think the next one is? What do we think their average annual increase is? We can see that over time and over history. We can see how their incomes increase. We can see when it's likely to increase. And we can see things like bonus and commissions that are typically hard to see. And we can extract those and find out, okay, well, what was the average over the last number of years? And how many times have we seen it, et cetera, et cetera. So it gives us a much better and richer way to understand how all of these things contribute to a customer's position. And unsurprisingly, what you see is quite different to what banks typically would collect when you start to add these things up. So here I've got a chart. This is real data, roughly around a representative sample of 10,000 from a portfolio of 300,000 customers where we were doing analysis on this. And we plotted on this chart here. The y-axis is the sort of ratio of applicants, and the x-axis is the shaded income. So the income that we would recognize adjusting for historical variation over the last 12 months. So we looked at 1 year's worth of income statements and said, okay, what's the variance? How many missed pay cycles have we got? And we basically created a statistical forecast, if you like, of what we would expect based on that behavior. And you can see that very few, only 10%, had 100% of what would have been put down as the income from their payee statement. Most of them had significant variances going down to almost 80% of what was sort of stated for various different reasons. It could be holidays, sick leave, or otherwise. And so it's quite different. So the bank already has got a different view of what the reality of the customer's income is. But that's not just for payee. The other really interesting one we found was rental income. Now, expert wisdom says, okay, well, rental income from investment properties, you need to account for time where potentially the property is uninhabited, or they're switching over tenants. But actually, when we looked at this for real customers and their rental income, and we tried it for 1 year and didn't believe it, so we went back 3 years and we looked at the stability of that income, you see a completely different picture. Actually, rental income is far more stable and reliable than your payee salary slips. And currently most banks would apply a blanket shading on rental income, which would allow sort of 20 or 25% haircut on what they recognise for credit purposes. So already we're seeing real differences in what the reality of a customer's data is telling us versus sort of traditional approaches to recognising these things. And then, unsurprisingly, when we aggregate all this up and then think about, okay, what does it mean for the income that the banks would assess for making a credit payment? We see a big variation. And the chart on the bottom here shows from what was the sum of all the sort of customer declared and bank recognized income that was put on a credit application, how that compared to then the aggregation of these statistically treated flows into the customer's ecosystem. And surprisingly, we see a number of customers where they've overestimated what their income is. The banks have overestimated based on what they've received and the customers declared, and they've underestimated significantly more because they've not been able to recognize more complex or different forms of income into that customer's ecosystem. So this is a really big thing. It has a real implications for financial inclusion and complexity of customer ecosystems that are currently not well served by banks today, but are possible to be served by transaction data. So if we look at that, that's great for the individual inflows, but then it starts to get even more interesting when we say, well, what does this tell us? And it tells us lots of really important things about a customer's job history. So we can see when they've changed their primary job. We can see also by implication when their source of funds have changed, which is something that's necessary for AML and KYC requirements, not something that the banks find easy to do. We can see how many job changes they've had, the average time in their job, even what type of job it is, total income growth, etc. So we see many things about the customer then that actually are really valuable for very different parts of what the bank needs to do and how they need to service their customers. The same applies on the expense side, and I'll go through this relatively quickly, but as you might imagine, when we start to be able to identify and aggregate out from all of their transaction information, the parts that are their utility bills, through categorization and sort of clustering mechanisms, we can then start to say lots of interesting information about them. Same when we start to say, okay, well, we can see what is likely spend on groceries. We can then aggregate that up and say, all right, well, now I've actually got a real statistical measure of what customers are spending on these areas that are not their best estimate, which they don't know, but actually the reality of their accounts. So we can get all the properties around these, the max and the mins and the means and the variances and the frequencies and how often these are happening. And similarly for bills, we can see, month on month, how much are they varying? How frequently are they being paid? Have they missed a payment, which actually is a great precursor or potential predictor of credit stress, which isn't yet reported to the bureaus. We can forecast their amounts. We can see when their bills are renewed. We can see how much they've increased, and we can also see how much they're paying relative to other customers of similar types, which is information that's very valuable both for the bank but and for the customer. And then, unsurprisingly, as with income, when we actually look at what banks collect now for example, in this case, general living expenses, when we look at the raw aggregate of these things in accounts, which is typically what banks have tried to do, you see it's very different to what would come from sort of that customer declaration and the discussion of like, what are your expenses? You see very large amounts. And that's often because these things are highly variable and there's large sort of one-off expenses that are hard to treat. But if you treat these statistically, you can get a much more accurate answer, but that still shows that what the bank is collecting looks very different to the reality of the customer's profile. So this data at the customer level is allowing us to have a much more informed view of the customer's real ecosystem and what's happening within it. So we think that's super important. For credit purposes, this means more accurate credit assessment, more responsible credit underwriting, more accurate modeling, and in many cases, a lot more automated and seamless experience. A customer is not expected to try and figure out what they can afford. The bank is actually able to use the real data about them to do that in a much more responsible way. And we think that's really important. So these things are not just useful for credit, and Nick alluded to this at the start. These are also very valuable for many different parts of what the bank is expected to do across the end-to-end value chain. So if we think about, for example, financial well-being and hardship, it should be relatively obvious to see that actually these things are really important. And this is very relevant when you consider ASIC's recent review into hardship management. Banks have this data on their customers today. For many of them, as I said, up to 60% of the major banks' customer relationships are main financial institution. And so with this, we can see things like the change of address, change of source of funds, change of primary job, change in family status. We can see whether they've got pets. We can know when they bought a vehicle. We can know when they've gone through major life events like marriage or divorce, or they've obviously purchased a property. But we can also see things that indicate potential vulnerability, like job losses or major expenses or major medical problems, or where they might actually be underinsured. We don't see insurance if they own a house. We don't see house insurance. So these things tell us about where there might actually be risk and concern for the financial well-being of the customer that is available today for banks to see. And in particular, we can also see behaviors that are potentially risky and challenging before these things turn into mispayments and financial distress. So total cash balance and drawdown on cash balance is a massive predictor, obviously, of where customers are in trouble, or when their cash balance drops below a certain threshold for a long period of time. That is almost always a signal that the customer is going through financial challenges. We can calculate from those things like number of months cash balance survival. We can see things around savings behaviors and financial literacy, potentially the amount of income they save per pay cycle, whether their balance is growing or not, and the volatility of their net flows, which tell us about ways in which they might have liquidity challenges in the future. We can see how they're using their credit. Are they transactors, or are they using it for emergencies, I said? Have they experienced compound interest? I think it's an interesting question to put to every bank. Should it be the case now, if a customer has cash in their accounts and they are earning compounding interest on their credit card, is that a situation that banks should be leaving them in? Especially when you can now see it when you start to look at this information. So there's a lot of really valuable contextual behavioral information that actually flows into ways in which banks should be thinking about managing the well-being of their customers and hardship. Now, this isn't theoretical. This is actually real, and we worked on the market on some of these. When we took these transaction features, this customer financial profile, and we washed it against roughly around 500 customers who had identified as being in hardship at one of the banks, we were able to, with very little effort, without any real iteration of these features, identify 7 out of 10 of those customers. One, not only that they were in stress, what the stress was, and we could see the event 2 or 3 months before they called the bank to tell them that they were in trouble and wouldn't be able to make their commitments. And so this is very real. There is a real ability to understand and help and support customers as they come into these events by interpreting and using this information at that customer level. And we think there's a real opportunity for banks to do more in this space. And we have been talking, in fact, to the Financial Counsellors Association about how they might be able to do the same using things like CDR, for example. It's not just credit and hardship. The other very obvious use case of these types of information is around fraud and financial crime, which is a huge focus of everyone in the market. And it should come as no surprise after hopefully listening to what we can do with this information that these things are hugely valuable for identifying potential risky behavior. This example here is a sort of disguised dashboard of the rules and features that actually are used to identify money mules in the market. And a lot of these features exist in many banks today, but they don't have the contextual understanding of the customer's inflows and outflows. And so in many cases, these are not actually capturing the patterns you want. I'll give you an example of this. To actually understand when transaction activity variance or burst activity related to income is important, you need to actually know what a customer's income is. If you don't know what a customer's income is, then you're just looking at total inflows into the accounts. And if you haven't aggregated and separated those things out, the signal is significantly diluted from what these things do. Similarly, if you're able to identify what is genuinely, payments for different types of recognized expenses like your groceries or your travel, etc., then you can focus in on the regular recurring payments to other accounts and other transfers, and then you can start to run sophisticated typology analytics on the behaviors that are within those. But you need that aggregate transaction view to be able to do it. You need to have been able to net off flows between a customer's existing accounts, and you need to have been able to separate out and identify these different flows in those transactions. But if you do that, then we are seeing now, and we're building this in the market, like massive difference in the efficacy of financial crime analytics and fraud identification. So huge value there. So sort of just summing up then, like we think, and we're seeing this, coming through in the market, that shifting to this view of customer and the financial ecosystem that comes from understanding a customer's transaction data has massive value for both banks and for customers in sort of many different parts of that end-to-end value chain. I didn't talk about it in the last few slides, but obviously there's implications for products and services. Contextualization of the way in which the banks engage with the customers based on what they're actually doing at the time that they're doing it. So event-driven engagement, thinking beyond just like what's the credit card use case, but what actually might a customer require in this certain situation, and can I create something that's much more tailored, combining elements of repayment tenor, repayment amount and limits, etc., that will actually fit the need that they have. How do I actually help customers get better at improving their financial outcomes, financial well-being 2.0, etc., and the value that they get from the services that I provide as opposed to the value I get from them, which has traditionally been the way banks think about customer value. So there's a massive opportunity there to improve the customer outcomes and experience. Obviously, in credit origination, as I talked about, many different benefits of using this, from financial inclusion, more responsible decisions, better experience, more accurate risk assessment, etc. These things are real. These things are happening in the market now, and we expect to see them coming through. And it's going to really change the way customers consume credit, we think, going forward. There are obviously implications around how banks can better help manage customers in hardship and the collections processes, and then the implications for financial crime, fraud, and KYC. Now, hopefully that all makes sense, but banks aren't doing this yet. And if I go back to the original sort of statement we had, thinking about this in a customer-first approach is one of the ways in which actually unlocks the ability to do this, but it's hard. Banks are doing bits and pieces of this. Forever, banks have been thinking about automating credit and the decisioning and making that more accurate, but it's always in the product silos. So I've got to, I'm going to do my credit card process a little bit better. I'm going to do my mortgage process a little bit better. I'm going to fix my, my hardship assessment, over here in this piece of the bank, but it doesn't touch anything to do with my financial well-being assessment of the customer in their mobile banking app. Like those two things are the same thing; they should be linked together. So the siloization within the banks is creating, a lot of challenge for this. It means that we see lots of times, even where they are building some of these features, they're duplicated across different parts of the bank. There's inconsistent methodologies applied. Customer outcomes, therefore, are inconsistent and lower than would be expected. And duplication means huge time and cost to do this. So we think one of the challenges that banks have to face into is how do I get really serious about thinking about the customer lens on this, and how does that feed out into silos? It's not an obvious or easy question to solve because, as I said at the start, all banks are typically organized in some way, shape or form across product silos within their banks. So that all said, I think this opens up a few interesting questions for the sector, for the market, for the participants, and possibly for the regulators. So I'm going to pose a few sort of thought questions to you that hopefully should be interesting. And I might flip to Nick as well to give his perspectives from the ABA on a couple of these. So the first one I think is really interesting around this is not illustrated. This is actually real capability. And what I've talked through now does exist in some banks today in small portions. But there's an open question, I think, for a regulator, like when does this not become optional? There's the context of reasonable actions to ensure well-being and health of customers, and sort of runs through a lot of the regulation expectations. But at what point should regulators be thinking, well, this data exists? When is it no longer defensible to say you can't use this data or you don't use this data? And when is it too hard? When I think about as a regulator, like what's the reality of the ecosystem today, the financial sector ecosystem? Like actually, we're not in the world where we have to get paper documents anymore. There is very verifiable, real, accessible ways to get data in a digital sense that's much richer on customers, and banks already have this in their systems. What should we be thinking about enforcing around the way that banks can actually use this data? And I think this is an interesting consideration. Where will the regulator go? When do we actually start to see much more expectation around doing this because of the benefits and the implications for customer experiences and outcomes? I might pass over to Nick. Actually, I thought this was an interesting question for you if you've got perspectives from the ABA around like how this might be considered. And we saw the ASIC hardship review, as I said, a month or so ago, and they stopped just short of saying that this is actually required, but they heavily implied that they do expect banks to start to be using this data in a much more responsible way.
Yeah. Thanks, Chris. Thanks for the insights and the tricky questions. Before I offer a view, I might just say to everybody, if you do want to ask a question yourself, in the Q&A bubble up on the top of the screen, you can type something in there, and if we have time, I will ask those to Chris as well. Sort of tackling Chris's question, I think one of the interesting things is Chris has pointed out that banks operate in silos. I think regulators also operate in silos. In fact, they're institutionally structured to do that. Either the regulator itself or within the regulator, there might be, if they're big enough, there might be some silos. I think what that means is that we're not likely to see a consistent change, but rather different regulators or different bits of regulators moving at different speeds on this question. And probably what will be interesting is a tension between, let's call it the safety net or the customer care type use cases, where perhaps regulators might be sort of saying, well, yes, you know about this information, or you should know about this information, so we're going to increasingly expect that you do something with it. On the other end, how open will regulators be to innovation in product targeting and definitions and new value propositions? We're taking advantage of this data. I actually don't have an overall view on that, other than I think it's going to take a little time to shake out. Possibly the other factor in all of this is the evolution of our both the legal structure, but also the social expectations around privacy, because that will shape this conversation quite a lot as well. I guess once the capability is there, at some point or other, it will become part of the assumption set, I guess, for the regulatory environment, and so increasingly banks will need to respond to that expectation.
Yeah, thanks, Nick. So super interesting. I think spot on. Interestingly, I have had conversations with the banks where even though much of what I talked about is sort of eminently possible, there's been reluctance potentially to sometimes go down that path, because once they've done it, they can't ignore the data. So they kind of don't, and because that has regulatory implications once it's surfaced, and they need to actually act on it. And so there is that tricky tension of like, well, once you open the kimono on this, like there's going to be a lot of potential implications from an operational perspective, a customer outcomes perspective, and then obviously like the regulatory coverage. Okay, another lens then to sort of consider, which we think is interesting when we look at this, is from a customer perspective, and it's maybe a different side of the same coin. But more and more we see that where you are able to use this information in a way that is operationalized, then we're going to start to see significantly different outcomes for customers, and not just in terms of like the quality of the products and the services that they can get, but the way in which they are treated in relation to those products. And there's an interesting question, which is, well, at what point should this stuff stop being competitive advantage and just become, a customer expectation around minimum level of protection against, say, financial crime and fraud, or minimum levels of, treatment and understanding when they're in financial difficulty and through hardship. And I think there's an interesting, for me, a question here of like, should it be the case that, customers are getting differentiated support because of the bank and what the bank has chosen to decide to compete on, when some of these arguably could be considered as just consumers' rights for being able to safely engage with the financial sector. So I think this is the sort of separate side of that question from a regulator perspective, from a customer perspective. When should this not actually just be a competitive advantage, but what is expected of sort of any organization operating in the financial services space? Nick, did you have some sort of thoughts on this as well? Because I think it's an interesting sort of other side of that question.
Yeah, it absolutely is. And for those of you who've got the Q&A bubble open, if you look at Deborah's question, I think it gets to where I was going to go with my thoughts on this. I'm going to make a really sweeping statement here, which is I think that the technological issues, like all technology, eventually they will be scaled and commoditized and made available at levels and through channels that will work for everybody. Now, I don't want to oversimplify that, but let's assume that that problem will be solved over the next little while. Where I think that leaves us is the question of competitive advantage out of this is going to come down to two questions. The first one will be the ability of the organization to actually think about how to use this data, right? What are the situations and when, and how do you bring it actually to meaningful life in a customer's life cycle? And it sort of ties into this, the aspiration that every marketer in any sort of service industry has always said is how do you become the trusted advisor, right? That's really old marketing think. This technological capability actually means that you need to put that to the test now. And as an organization, how do you use this sort of insight to become that trusted advisor? That will be the number one challenge. And then I think the second challenge will be how to have the conversation with the customer. Some of this could sound really creepy, right? Like, there's Big Brother overtones to some of this. Being able to articulate to a customer to get their consent, their understanding, their expectation around what you should be doing and why. And I'll contrast two different scenarios here. Right now, in the battle against scams, banks are increasingly intervening based on flags that, not as sophisticated as what Chris has outlined, but flags that indicate that something here might be a scam. Sometimes that intervention is really unwelcome from the customer because it feels wrong. But you can explain that, I guess, in terms of trying to do the right thing by the customer. Now, on the other hand, if some of these insights said to me, guess what, Nick, you're not going to get a mortgage because we can see you're spending a bit too much on red wine every month. You know what? That's going to be a really different conversation to have. So what are we going to do with this information, and how are we going to talk to our customers about it? Once you accept the premise that the data itself will be commoditized, that's where I think the conversation is going to go.
Yeah, I think that's spot on again. It's a really tricky paradigm where, as you say, this information exists and the banks technically have it today, but then how you consume it and surface it and use it in the context of customer interactions is going to be hard, and it's not going to be seamless, and it's going to be quite scary when customers actually realize what potentially banks know about them, and that's aside from the fact of, well, how do you actually help them get the right outcome in these cases, and some a consistent sort of set of experiences. So I think, yeah, it's not an easy question, and it's probably going to be an area of debate for some time, I think. And then maybe just to close off the sort of final thought here, clearly the playing field isn't level, right? It's really, really hard still, despite all the things that I mentioned, computing power and analytics and data sophistication, to build this stuff yet at the moment. The bigger banks are really advantaged in this. They have very large portfolios of customers, so they can actually build and do more sophisticated services analytics on customers using this data. But for banks that are not at scale or of that scale, this is much more difficult, and they have many other things to think about and focus on. And so in theory, while this is all real potential now, it's not practically achievable for many parts of the sector yet. And so if we still see continued evolution in this, then we're going to start to see potentially a widening of a gap in sort of customer outcomes, experiences, and services that's very difficult to close. So, sort of a closing thought is, well, what could be done around this? I think, Nick, you sort of alluded to this before around, well, maybe there's a role or a requirement or a need for some more common infrastructure that starts to bridge that gap where it's too hard for smaller players to potentially build this stuff. Well, actually, there should just be a common way to be able to use this data to create at least a view of a customer that is equitable and the same that everybody has, and so that you don't get this differentiation in treatment, for example, potentially. Who should do that is probably another good question. Is it government, or maybe a role for a bureau that already have some of that role? Or maybe there are consent management infrastructure players who are sitting in between digital data sharing ecosystem today in CDR that maybe could extend into this. And then, the sort of final thought here is, there are other developments that may impact this, right? We won't go into it now, and I know it's a topic of conversation that I've had with Nick around. CDR has all this data in it, but it's not set up yet to be successful, and it needs to change in the way in which it's implemented. And if it does, then that might change again the focus on this. Just heard it's action initiation has been approved for implementation, and that again might change suddenly the focus and thinking around this. And digital ID as well could be an unlock or another sort of adjacent element that starts to change the way the sector thinks about it. But I think the reality is the potential is there. The ability to consume it yet is not equal, and so there's probably a question for the sector around what does that mean and what do we do about it. So I'll finish up there. Nick, I can't see the questions and answers, but if there's Q&A, I'm happy to take in the last sort of couple of minutes that we've got. I think we've got about 4 minutes left.
Great, thanks, Chris. Look, certainly an awful lot to think about already in your remarks. There's one question that is in the list here that we haven't sort of covered, and it goes back, I guess, to some of your original, the first part of your deck, but the validity and accuracy of the data. It's great to build all of these wonderful castles of analytics and new customer propositions and new regulatory obligations or whatever. But what do we need to do to actually make sure that the underpinning data is actually correct and validated and trusted and et cetera? Because that whole sandcastle collapses if that foundation is not in place, right?
Yeah, absolutely. And I think it's a great question, and it's one we've actually been sort of debating in the market in real time, if you like, and the sort of tension between, well, the ways in which banks think about validating data before, which I sort of touched on, typically is like in my payslip, and then what's actually in their bank accounts and like what's actually true, what the customer says or what you can actually see. I think that, there's a separate question around, is that transaction data accurate in the the account information you get? But I don't think that should be a question. That should be a mandated requirement. Like there's no scenario where it shouldn't be the case that what you're getting out of your financial statements for your transaction accounts is not true and accurate representation of what's flowing in. But the interpretation of whether that is the entirety of a customer's sort of exposure or sort of income profile, that's still to be had. Generally, I say generally, like the most recent conversations we've had, we've started to see a slight shift in sort of the risk mindset here of like, well, we may have got given this sort of statement or this customer data here, but this is what we see, right? And this is what's flowing in, and actually that's the source of truth, because that is genuinely what's flowing in and out, and that's what's going to be used to meet my credit requirements. And so there's this sort of shift to start to be thinking about, well, actually that data is more accurate than what I get sent over here, because that's the reality of what they're paying for their service from.
Can I just go a little bit further on that? Like the fact of the flow, the in and out, the amount, that's there. It's part of the ledger record. The classification's a little trickier. Like a lot of people, I sit down every month with my husband, go through the credit card bill, and we're like, who spent that? And you look at it, and the merchant information doesn't really help you much. And it's like, well, and then eventually you go, oh, I know what that was. Now, that sort of underpinning of that really low level data classification piece, can AI just get over the top of that, or do we actually need to reform the way we have that structure?
It's a really great question, Nick. My first sort of point would be, this isn't solved yet, but it goes to my point around a different risk philosophy and mindset about interpreting this information. And as I said, the prior approaches to this was to really get very specific on what is it and where does it come from, because that's what I can validate and I can infer from that certainty. So because it's a page e-slip, I infer that that's stable and can be considered, even though the person could lose their job at any point. There's always somewhat of a fallacy. And so the shift in risk mindset that we're seeing of starting to use this is, well, I don't really know necessarily 100% where it's coming from or what it is. The categorizations, you say, is not accurate by any means yet. And 100%, maybe 7 out of 10 are pretty good, and then there's 3 out of 10 that probably are just not right. But what is accurate is the statistical properties. And then that's actually what I start to build my risk assessment on. It's like, well, I don't know for sure if this is, a salary, But I've seen it every month for the last 48 months, and it has this property, and it's been this amount, and the variance has been this, and it's a 0 mispay cycles, and therefore I'm going to have a statistical risk assessment that I can rely on that for future inflows without having that 100% certainty on what the source of it is, because technically that is as good as saying, well, I've got a pay slip, because I don't know with any certainty that that's going to continue next month. So it's a great question. It's not easy, but we're starting to see that shift to thinking about, well, what are the properties of this thing rather than the source of the thing.
Great. Chris, I think we probably could keep this conversation going on a lot longer, but we have actually run out of the allocated time for today. So thank you for sharing your insights. Thank you to everyone who's joined in today. The recording of this webinar will be made available through the ABA afterwards. And we'll also be sending out a post-event survey asking for feedback on what you all thought of it. So please do take the opportunity about what we did well and what we perhaps could do better. I think both the ABA and Oliver Wyman would appreciate both of those aspects of feedback. And we'll see you hopefully in a couple of weeks' time for the last of our series this year. So thank you all. And once again, thank you, Chris and Oliver Wyman, for sharing your insights today. All right. Goodbye, everybody. Thank you.
Thanks, Nick. Bye-bye.